if this truly is a market that is being set free from the paper suppression because of the massive amounts of delivery across the globe, and it seems like it is. If it is, hang on tight, strong fingertips, do not let go, do not let someone talk you out of it. I think it's just beginning, but well, you know, I mean, I like to try and kind of make it easy then again, and you know, I think, first of all, I just try to strip the noise away. What we're watching in gold and silver, to me, if I could break it down easy, it just seems to me the ending of a paper-based pricing system that's colliding with a form of physical reality. And I can't see how this ends quietly. And, you know, you can see also what's happening when people seem to think that these banks have unlimited power. And if you've been in this game long enough, it feels that way. And when you see a major bank like TD Bank shorting silver in a market this tight, it tells me one thing. It tells me they're trapped and in a system that ultimately is making them pretend that supply exists when it really doesn't, because TD Bank put on a trade, a big short trade. And that short trade, in fact, it's very silly to short something that's backward dated like this is. In other words, you're shorting something and the traders are paying a premium to have it right now. To me, and something that was just classified a critical mineral, the only reason you'd be stupid enough to do that is because you have to. And the funny thing about it is that they sent out a report saying we think silver's going to like 45, and they just recently got stopped out at 92. In other words, they had stop losses put in place to get them out if it went the other way, and they lost a good amount. I don't know, a couple $100 million or something. I don't know what they lost, but that's not the point. The point is that they sent out a letter saying they thought it was going the other way. They got stopped out. This was forced buying, and this is how accidents start, because you're stupid as hell to short something naked in a market that is in backwardation.
Many assume large banks possess unlimited power in commodity markets, but recent actions suggest otherwise. When a major institution takes a large short position in an already tight silver market, it often signals distress, not confidence. Shorting a backwardated market, where buyers pay a premium for immediate delivery, defies basic logic unless the position is forced. Silver has now been labeled a critical industrial mineral, vital to energy, defense, and technology. Losses triggered by forced buybacks reveal a deeper issue. Some institutions are betting against supply that no longer exists. This is how market accidents begin, not through speculation, but through desperation.
And I think that, you know, you look at what we've seen along the way, how these banks that are somewhat trapped are trying to change things to get the price back down, but they can't do it again. Even when they dump paper in the dead of night, when liquidity is the lowest and the price goes down, we see physical stress going back up. And in other words, every time it goes down, the physical's being bought. December was the largest delivery in the history of the COMEX market for the month of December. Somewhere in the neighborhood of like 68 million ounces of silver were delivered. That's not bearish. Anything to say the least for the people who saying that the top is in. And I think when you talk about all these people, the talking heads that tell you that the top is in, like TD Bank or the Jim Cramers, the part that these people miss is that even as the paper price fell, the lease rates exploded higher. To me, that's the tell. And when it costs more to borrow real silver, the market is screaming, we don't have enough metal. These lease rates are normally 1/4 or 0.5%, not 8 or 9%. When you put backwardation in, that seals the deal to me. That means don't promise me silver next month. I want it right now. And that only happens when trust breaks. And for all of the people out there who are being told that this is the top, This is just like 2011. 2011 was leverage and speculation, right? And you had traders that were speculating with leverage, and when they raised the margins, they all got kneecapped. Here they raised the margin the day after Christmas by 30%, and it doesn't do anything but just a little speed bump as the big money comes in and buys the most, or stands for delivery, the most that's ever been delivered in the history of the COMEX market since 1974.
While paper prices fluctuate, physical indicators tell a far more compelling story. Record deliveries on major exchanges, including the largest December silver delivery in modern history, point to intense demand for real metal. Each time prices are pushed lower through thin, low-liquidity trading, physical buyers step in aggressively. This behavior undermines claims that the market has peaked. Even more revealing are soaring lease rates, which reflect the true cost of borrowing actual silver. When lease rates rise from fractions of a percent to near double digits, the message is clear: supply is strained, and trust in future promises is eroding rapidly.
So it's not working. These people don't trade on margin. These big sovereign wealth funds and, governments and Teslas and Samsungs. And today is not about leverage and speculation. That's the speed bump. Today is structural shortages across the world, a declining mine supply 6 years in a row, exploding industrial demand. We see that everywhere, especially with AI and photovoltaic and all the way down through military and everything else that we've covered copiously. But it's the sovereign and the industrial buyers competing for the same metal, where, it's now critical. And I think that's something, to me, where, the people who analyze the markets and tell you, like your financial advisor, this isn't a trade. This is infrastructure. And I think you don't permanently top when supply is shrinking and demand is growing. And I think the same thing is true with gold. And again, this is just kind of my overview, because I hear a lot of people saying, am I going to lose now? Should I sell? Should I take some off the table? Central banks don't buy gold because they're emotional, first and foremost. They're not catching the trend. They buy it because it's nobody's liability. Gold didn't overtake the euro because it's shiny. As far as I'm concerned, gold is doing what it's doing by default because there is no replacement for trust, period. And I think that's what it comes down to. And when you see interest costs exceeding defense spending, you can see that the system has chosen its path with it, which is debasing, printing, inflating, whatever the hell you want to call it. But this is why central banks are buying gold. This is why silver is being drained. And this is why the paper promises are BS, and they're starting to show up as such.
Comparisons to past peaks miss a crucial distinction. Previous bull markets, such as 2011, were driven largely by leverage speculation. Today's market is shaped by structural shortages. Mine supply has declined for several consecutive years, while industrial demand is accelerating. Silver is essential for solar energy, artificial intelligence infrastructure, electronics, and military applications. At the same time, sovereign buyers and global manufacturers are competing for the same limited supply. These participants are not trading on margin. They are securing long-term resources. In such an environment, raising margin requirements barely slows demand. This is infrastructure accumulation, not speculative excess.
And now let's just talk about a few other things. Going back to the financial advisors, I hear this a lot lately. You need to sell. They're looking at the charts, they're looking at the ratios, they're looking at the headlines, the ETFs. They don't look at the deliveries, they don't look at the lease rates, they don't look at backwardation, they don't look at who's shipping the metal out and who's buying it in, where is it going. By the time this system admits stress, the positioning opportunity is already long gone. So I don't know. I just wanted to say that. Let me see. Do I have anything else here? TD I talked about. Oh, there was an interesting report written by Van Eck. Did you see that? Financial Advisory. They said if the dollar loses reserve status. Now, what have I been saying? I've been saying it is my belief that they want to soft default on the reserve status. It's what they want to do. They want to no longer be the world reserve currency over time in order to bring back manufacturing. Triffin's dilemma says you cannot do it if you are the world reserve currency. Vice President Vance has written about it, talked about it. Jared Bernstein, the knucklehead from the chief economic advisor from the Biden administration, wrote a report, Dethrone King Dollar. It is very much well known, if you retain world reserve status, you will never have a trade surplus. And I think that's where they're going. We've talked a lot about that. I mean, I've gone over it copiously on many podcasts, but Van Eck comes out and says, if the dollar loses reserve status, gold could surpass $39,000. And it says, what if gold replaced the US dollar as a reserve standard? In this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a $39,000 to $184,000 per ounce price target for gold. And if they were to divide central bank MO, which is the most immediate form of money in the system, they come up with $39,000. If they use M2, it's $184,000. So anyways, the bottom line is you got a mainstream financial advisory saying, well, what if? What does that mean? I don't know. When people hear that it's James Rickards doing it, that goes in one ear and out the other, and out the other. I wonder what they'll say when Van Eck is doing it. Just a couple other things. Let's see. I don't think I have anything else. How about questions, Dunnigan? What can I do to answer the questions that were submitted?
Gold's rise is often misunderstood as emotional or speculative. In reality, central banks buy gold for one reason: it carries no counterparty risk. Gold has surpassed major currencies in reserve importance, not because of sentiment, but because trust in fiat systems is eroding. As government interest expenses begin to rival or exceed defense spending, monetary debasement becomes the chosen path. This reality explains why gold accumulation is accelerating globally. Recent mainstream financial research even explores scenarios where gold partially replaces the dollar as a reserve asset, producing valuation models far beyond current prices. These discussions signal shifting assumptions at the highest levels.
Well, any of those odd weight coins that they tell you are special. First of all, I wonder if they know that you and I sell precious metals. I hope they do. But any of the coins that sell the odd weight, third ounce, 1.5, 1.25, these are all first telltale signs that the company is fugazing a scam. Secondly, when they tell you that you don't want bullion coins, you want the premium coins, run as fast as you can as if you're being chased by a lion and you're coated in cooking oil. Run. All I can tell you is that people should listen to, on my YouTube channel, Miles Franklin Media, the interview I did with Dale Whitaker. And Dunnigan, I suggest you have Dale Whitaker on your show also. He is the whistleblower from, I believe, Augusta Precious Metals. And he came out and is whistleblowing against the entire industry. So those that are taking part in this kind of stuff, I think you have to listen. All of the companies he's mentioning, some of them I'm sure are, they deserve to say their side. But I will tell you that it is my experience that many of these companies that he talks about are really harming people. And it's the same model across the board. It's fractionalized coins in weird fractions. Like the U.S. Mint does 1/2, 1/4, 1/10. Okay, cool. They make 1 ounce gold. Okay. When you see 1.5 ounce, 1.25 ounce, 1/3 of an ounce, these are all odd weights, and they do that by, on purpose so that they can sell, they being these mints, whether it be the Crown Mint or the Royal Canadian Mint or the Perth Mint, they allow people or companies to buy dies, if you will, a mold or a die in an odd weight and in an odd designation, like Crown Guinea. What the heck is that? But if it were a Britannia, no, it's not going to fly. Or if it's a Maple leaf, no, that ain't going to fly. But if it's a Canadian black bear, well, there is no Canadian black bear unless you want it, sir. At 1¼ ounce, it can be yours too. And that's exactly what they're doing. Run. But watch the video with Dale Whitaker. Google him, buy his book. Not just on my channel. He's going all over the place trying to wake people up to what you and I have tried to do here for the last year. So, yeah, they're out there. They're real. Give us a call. We'll tell you if you got in trouble.
As stress builds, misinformation becomes more dangerous. Many advisors focus on charts and headlines while ignoring delivery data, lease rates, and physical flows. By the time systemic strain becomes obvious, opportunity has often passed. This environment also attracts bad actors selling overpriced, oddly weighted coins designed to confuse buyers and inflate margins. Unusual denominations and exclusive designs are common red flags. Investors should prioritize transparency, liquidity, and widely recognized bullion. Whistleblowers within the industry have exposed these practices, urging buyers to stay vigilant. In a market defined by scarcity, education and integrity matter more than ever.